Hey traders, Raghee here. Welcome to Charts and Coffee. And just as I was starting the show, my charts started. All right, let's see where they go. Where did they go? That's the fun part of having 9 monitors. Sometimes they just disappear. All right, there we go. Okay, welcome to Charts and Coffee. We have an unusual trading day today in that, let's face it, folks are going to be phoning this thing in. We had the FOMC meeting minutes yesterday, new home sales yesterday, Chicago Consumer Board, not Chicago, Consumer Board, Consumer Confidence, talk about redundancy, Consumer Board, Consumer Confidence number yesterday, and nothing really seemed to derail the strength that we continue to see. I did a video yesterday. You can find it over at the Simpler Trading YouTube channel, probably the one you're on right now. And you'll see I did a video called "This is the Season for Buyers" or "The Season Favors the Buyers." Bottom line, gosh, Rog, are you saying that we need to buy the dip? You need to buy the dip. And that's all we've been doing. Where to buy the dip is the key, though. And that's where in that video I get into a number of the sectors that have been where the buy the dip is working the best. And what does that mean to work the best? 1 or 2 good days? 3 good days? Look, I want more than just a momentum breakout. I want this thing on a daily time frame setup to last for days, if not weeks. On an hourly time frame setup, I want it to last for days. And this means that we're not just talking about 1 good day or 2 good days of movement in favor of our trade, but rather consistent follow through that even after maybe a little bit of a dip, the trade gets right back on track. And that's the kind of thing that we're looking for if we're going to be a trend follower. That's what I do. That's what works. And that's what I will continue to look for. So let's go ahead and take a look at what we've got here on the daily time frame of the S&P. The XLF continues to be one of the stronger sectors right now in the broader sense of the high concentration weighted sectors. So if one end of the spectrum is financials, the other end of the spectrum, the absolute worst sector in terms of strength, but if you want to think about it as the best sector in terms of weakness, is healthcare. You've got, on the other hand, NASDAQ sectors. You've got the XLC and the XLY, very strong. XLY led by Amazon and Tesla, XLC led by pretty much everything but Meta and Google. And then you've got on the other end, a sort of flat, if not disappointing, month and frankly quarter in semiconductors and in technology. So think sort of a lackluster Microsoft, lackluster Apple, lackluster NVIDIA. So it's not as if we can buy everything. And it's certainly not as if we're looking to buy the popular things, right? And ultimately, what we're always going to be doing is looking and waiting, looking for the trends and waiting for the dip, rinse and repeat. So Jas asks, am I just managing current positions and waiting for pullbacks for new entries? Jas, frankly, what else would we do, right? What else would we do? Yeah, so I'm going to manage current open positions, and then the next setup, and like you mentioned, the pullbacks, it'll be the next round of trades. Absolutely. Okay, so let's go ahead and take a look at the NASDAQ. What do we have here? This is the laggard, right? This is the laggard. Why? Because if there are, think of the NASDAQ as a motor and think of the cylinders as the sectors that are heavy concentration weighted within it. So the cylinders here, the sectors, are not really allowing the motor to perform at optimum levels, which means there's really 4 cylinders in the NASDAQ: technology, communications, consumer discretionary, semiconductors. And now with the increased weighting of NVIDIA in the XLK, SMH and XLK move very, very similarly. And that means that 2 out of the 4 sectors, 2 out of the 4 cylinders really just aren't firing. Well, two of them are, and it's going to lead to less than optimal movement. All right, well then why is the Dow and why is an S&P moving higher, hitting new highs, pushing towards, again, consistent? I think the Dow just hit an all-time high again this week. So why is this outperforming, right? Remember, gang, there's no the markets, right? I know largely folks are sort of referring to the S&P, but there's no such thing as the markets. I try not even to say that. The markets are what? It's indices, currencies, treasuries, metals, energy, softs, grains, meats, the list goes on. If we're talking about building a watch list, there's never the market. There's always what's the relative outperforming stock or sector or whatever, right? So in this case, why is the Dow outperforming? Energy has been back on the rise pretty recently. Financials are the number one weighted sector in the Dow, the number two weighted sector in the S&P. While tech does have an influence in the S&P and the Dow, it's not the driving force, right? You have 500 names in the S&P, some of which are financials, some of which are healthcare, some of which are energy. In the Dow, you've got energy, financials, healthcare, industrials, transports. So if other cylinders are firing off, then that's why the S&P can outperform the NASDAQ. And it's not leading, right? Leading is about, frankly, the dumbest thing we can say, because leading suggests something is knowing something that the other sectors or stocks or indices don't, right? There's actually absolutely no such thing as leading anything, because leading suggests a certain amount of prognostication, a certain amount of prediction, right? It's only understanding what the sectors or what the rationale is under the surface. So leading just becomes this lazy way of basically saying to the world, I really don't know why this is moving better, so I'm going to just tag it with this leading indicator. Nothing leads, gang. Some things are more influential than others. So that's what we're looking for. What's influencing the current environment? Frankly, financials and energy are moving, not actually in any way benefiting the NASDAQ, because there is an expectation that there will probably be a different set of regulations, probably a little more accommodative towards energy and financials going into next year. That doesn't mean financials and energy are leading. It just means they have a different set of reasons to be bought, right? And if we keep that in mind, we'll be able to find the things that are moving and not presume it means anything more than that thing is moving at higher highs and higher lows fairly consistently. All right, so that's what we've got. If you checked that video out yesterday, you'll notice I mentioned a number of the stocks in the XLC, XLY, and I believe XLF. And those are still great places to look. And then another place that we've been talking about really consistently is the Russell. And you'll see I have an alert here. So here's a great tip. I think it's great. Do it with it what you will. When you have a symbol that's on the radar, we're looking at so many things. If you have a symbol that's on the radar and you're thinking, gosh, I would really love to buy, the Russell or the IWM if it trades down to a certain area or a certain price level, place an alert at that price level. That's it. Have your platform be your trading partner. Have it be your second set of eyes. And that frees you up to continue to scan for other opportunities. Place those alerts. Now, I'll probably have to change this a little bit, but actually it's not that different. It might be a smidge higher today, but I want to buy a dip, kind of going back to Jass's earlier question. I want to buy a dip in the RTY. That could be through micro RTY futures, the RTY futures themselves, the IWM ETF, which tracks with that RTY. There's so many things we could do, and it really does start with a pullback. KRE is the number one sector in terms of strength right now. KRE is the probably most significant weighted sector in Russell. And so if I can get a pullback here, it would be very similar to the Russell setup. So if I get both pullbacks, I'll likely allocate fewer dollars to each trade, so I don't have a disproportionate amount of risk exposure. Exposure is risk, gang. Yeah, most people look at it as potential reward, but let's look at it intelligently. Exposure is risk. Being exposed to the market as a trader does carry a certain amount of risk. So that said, I'll likely lower the position size and the desired account risk in both of these. However, I do want a long position, and you'll notice the RTY is likely probably a little bit closer to a potential trigger, so we'll keep an eye on that. Well, what could trigger the volatility for an entry? That's another part of the conversation. So let's jump on over to the economic calendar. All right, here we go. So here we have the economic calendar, and I'm going to scroll over to Wednesday. And what do we have? Today we had the preliminary GDP. That was at 8:30. GDP matters almost zero. Once upon a time, gross domestic product was a big deal, whether it was preliminary, final, whatever, right? It was a fairly important piece of data. It's not anymore. And the reason is this was the metric to whether or not we're nearing recession, whether the economy is expanding or contracting. But really, this has now fallen to second place because Jerome Powell and the Federal Reserve have decided to basically override GDP and have their own assessment of expansion or growth. In some ways, I think the Atlanta Fed GDP now is maybe more influential than preliminary or final GDP numbers anymore. So strange reality. Not to mention, there was a time we did have two consecutive negative contraction of GDP, and the Federal Reserve said, nope, that's not a recession. It's not a recession now. And it really had traders like myself saying, well, if no one cares what the typical historical definition of a recession is, then this data has become basically unnecessary or just not influential. And if you take a look at the economic data, it came in line. So there probably isn't much reason to make much movement anyway, but it's as if the indices just did not care. Now, just because the indices right now are not moving in a way that suggests GDP is important does not mean that yields, Fed fund futures, bonds, notes may not move. But right now, the indices could care less really about GDP. That brings us then to core durable goods, pretty much glossed over. Today's 10 a.m. core PCE. Now that could be important. I haven't cared about inflation since we got our 50 basis point cut in September. Why do we have to care about it now? Because the Federal Reserve has really opened up by way of their messaging, the words, has really opened back up the notion of live meetings and not sort of a path forward where traders and investors can say, look, the Federal Reserve is going to cut at least a quarter at each of the next, whatever number of meetings, which was largely the expectation going into June of next year. And then Jerome, week before last on Friday, said, not so much. And you could see the target rate probabilities pretty much drop to even, where it was basically a coin flip as to whether we would have a quarter point cut or not. Yesterday's rally coincided with an increase, as you can see right here. And some of this might be due to the data we got this morning, could be due to the disappointing new home sales yesterday. But we have seen at this point, this is actually a 10% higher reading than I saw yesterday. So once again, we're starting to see the probability of that quarter point cut on December 18 back in play, right? So this is not a matter of what the Fed, and it always makes me laugh when traders want to start to say, well, this is what the Federal Reserve should do, and this is what the Federal Reserve is, and this is why they're so dumb, and this is what's going to happen within, oh my gosh. I always laugh when I read those comments, whether they're on my videos or whether they're on Twitter or whatever. Our job is not to act as fantasy football version of FOMC, right? That is not my job. My job is to look at the data, look at the trend of the data, and ask, what does this mean today? Or at least until that data suggests otherwise. And if that moves higher, gang, this is not the time to be bearish, right? The whole year has not been the time to be bearish. When we think about monetary policy becoming more accommodative, lower lending rates, lower borrowing borrowing rates, a weaker dollar, that's not necessarily something stocks hate, right? We could start to nitpick why that might be a bad idea, but who cares, right? That's not how we get paid. So if rates are coming down, that is going to favor the upside. Punchline, buy the dip, right? In those places where the trend is best, in those indices that are structured right now in the most bullish way. And then just continue to remember the overarching influence of the current environment is window dressing. So things that have been strong will get stronger. As a general rule, doesn't mean they're going to make higher highs every day. Please no. We're going to have pullbacks from time to time. But ultimately, the idea is if we can buy a pullback in something that's like this is trending, we're going to have a better shot at follow through. So please, 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 not just this time of year, but any time of year, this notion that just because something compresses, that it's going to suddenly expand and go to the moon is categorically wrong. And it's far less effective than just waiting for a trend to correct, to retrace, a mean reversion, whatever your idea of an uptrend sinking back down to support is. There's lots of ways to do it. I use the daily price movement ranges for the most part. Nothing is going to outperform that in a trend. And even if there's a consolidation to expansion type breakout, if you can find those in the context of an overall bullish trend or a bullish environment, that too could be considered sort of a variation of buying the dip, right? A dip can sometimes look like a little bit of a pullback and consolidation. A dip can sometimes look like just consolidation. So keep that in mind. As long as you prioritize the trends, you're going to get follow through. So I usually like at some point during these charts and coffee shows to show you what we're doing in the Sector Secrets Mastery room. So hang on one sec here. Let me get this font out of 400 or whatever this is. So if we think about where our current positions are, what type of position we're looking at, this was the Tuesday trade recap. There we go. This was the Tuesday trade recap, and I did not get a trigger, although I'm looking for it. All right, we have, what is this today? Blueberry smoothie today. All right, so we got the blueberry smoothie delivery. All right, so what we have is Open Wells Fargo, Open Alcoa, Lincoln, Financials, Amazon, Walmart, and Energy. Couple notes here. Amazon did hit the first target, so now it's at break-even stop. And then Lincoln, after hitting the first target, is at least a break-even. We hit an optional second target. We always think about 3 targets potentially, so we could have even a tighten stop on Lincoln. The only trade right now is that's not at some sort of break-even is XLE. So what that means is it's still vulnerable to losing a certain percentage of the premium paid and being a loser or a net loss in my account. The rest of these positions, and we're pretty active right now, we have 8 open positions. The other 7 are in some form of now just profit management. We're not in that loss management mode any longer. All right, so that's what we've got right now in the Sector Secrets Mastery. By the way, just a quick heads up, I will be starting our morning of day trading. And I will say day trading has been okay. It's not been great, but it's been better than maybe it has the last 6 or 8 weeks. And slowly we're getting better intraday follow through, but certainly not in any way for me outperforming what has been a great 2 quarters of swing trades, right? And so we'll continue to look for those dips. I mentioned the places that I'm looking. Keep an eye on the Russell, and that's really where we want to focus on not just strength through the end of November, but into December and into the new year. This is not about a Santa rally, gang. Santa rally is a very small window between Christmas and New Year's Day. This is window dressing, and it's on. So I'll see you all, not tomorrow. Well, maybe, I don't know. We'll see. Sometimes I do a Thanksgiving Q&A session. We'll see. But you'll get the notice if I set up the show. In the meantime, I will see you on Friday for Charts and Coffee. So if I don't see you tomorrow, happy Thanksgiving. I hope you have a really great turkey and football and or whatever you do to celebrate Thanksgiving with your friends and family. And if turkey's not your thing, you know, the markets are closed. Take some time to read a book. Okay. All right, gang. Be good to each other. I'll talk with you soon.